Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Chicago Board of Trade corn prices this year down 32%. What is up with that? I'm eating as much corn as I ever have. I don't know what's going on with the price of corn. I guess it's more supply than demand because it's a commodity. But let's check in with somebody who does this stuff for a living. Literally, Mike McGlone, Senior Macro Strategist for Bloomberg Intelligence. Mike, I like corn as much as the next person. Why is the price of corn down 32%?
Well, hey, Paul, as the farmers say, it's the higher price cure. That's the bottom line. Corn had a big pump last year on the back of Russia's invasion of Ukraine. And what does that typically do? It incentivizes plenty more supply, and we're seeing it globally. The U.S. is catching up a little bit. This should be a very good crop this year, near the highest production ever. And most notably, what had the most time to pick up was the massive supply of corn and soybeans out of Brazil. And they just do what they've been doing for the last almost 20 years. They just amp their production. And when farmers can make profits, they always create a lot of supply. And that's the key thing to remember about corn, soybeans, and wheat is they virtually never stay up because farmers can make more money when they'll plant when they can make money like they did last year.
You're right, because soybeans are down 10% year to date, and wheat is down 28% year to date.
Yeah. So America has held the top spot in terms of corn exports for years. But now Brazil may be challenging it. What's the dynamic there? And does this increased competition, is that going to weigh on the price of corn for the foreseeable future?
Absolutely. It's the price of corn is heading towards $4 a bushel. Right now, it's just above, just below $5. And it first traded that price in 1974. That was on the Great Grain Robbery when Russia imported the then Soviet Union imported a whole bunch of grain. But what you pointed out, Simone, our body's in motion. Brazil's production has been increasing rapidly for at least the last 10 years. If you just look at charts going back to beginning 2000, and it's still heading that way. But what happened with this war, which we pointed out right away, just created more and more incentive to produce more corn. But also there's been a paradigm shift in the U.S. The U.S. now uses almost 40% of the crop for ethanol. But the unique thing about that is, that's for motor vehicles, for gasoline. The unique thing about that is it's just going back the way we were before. In 1920, before the automobile became proliferated, a lot of the grains that were grown in this country, oats and hay, were for feeding horses. Now some of it feeds cars. So, but that's the key thing to remember about corn. In most agriculture countries, most countries in the world subsidize their agriculture production, and we're getting to the point now where farmers may be able to be subsistent without a lot of these extra programs from the government. A lot of it's because we use it for clean fuel, for ethanol.
Mike, that is so interesting.
I know it's all intertwined. How hard or how easy is it to grow corn?
So corn it's difficult. It's the most fertilizer intensive crop. And as we mentioned in an earlier segment, a lot of farmers will say out in Illinois, where I'm from, they'll grow beans so they can plant corn the next year. But it's the most intensive you need a lot of anhydrous ammonia, which is the base for that is natural gas, which has plunged this year, which means cost of production is going down. But it's harder to grow. Beans are much easier. You don't really need a lot of fertilizer. But when you work them in rotation, they all work out better together.
Well, and it's interesting, you were mentioning the impact of the Russian invasion of Ukraine before, but fertilizer is a place also that is so incredibly dependent on China and Russia. And what it sounds like you're saying here is not that our desire for corn is or the global demand is falling anyway. It's simply that the U.S. is eating up more of the overall share for itself for non-eating purposes. But does this add to do these shifts add to some of those sustainability concerns as the United States is increasingly dependent on corn for transportation issues as well?
Not at all. We can grow more. We still have about 10% of our entire land in what's called the CRP, the Conservation Reserve Program. I used to have my farm in that for a little while. And it's where the government pays you to not farm. So obviously you're not going to put your best form there, but that's the key thing about, let's just point out the facts of deflationary forces in corn. The average acre of corn planted this year will probably produce about 175 bushels per acre. Just 50 years ago, it was half that. So that's just what's happening with rapidly advancing technology, new seed technology, new planting techniques, is we can just create more with less every day. That's normally what happens with commodities. And corn is the most significant agriculture crop on the planet. And the U.S. has been the epicenter, but don't worry about us creating more. And even if we have a severe drought, there's a lot of different time zones. There's irrigation, and there's plenty of production coming out from south of the border, from Brazil. So, I look at it as, I always like to point out, when people get bullish, when markets go up, grains are the number one commodity you never want to buy after they go up. It's a higher price cure. And here's the new thing about ethanol is we are now rapidly going to EVs. Total consumption of unleaded gas in this country is still about 5% below where it was before COVID. And now we're switching EVs so fast. Total sales of automobiles in the world now are almost 15% EVs. All that was accelerated by the war, and that means a lot of the demand source for corn might be going away.
And I should note, I'm looking at our chart of corn prices. We're back really to levels where we were in mid 2021, October 2021, it looks like. So as you said, be cautious about getting into commodities after spike.
Mike, the McGlone family used to own a farm in Indiana. How many farmers are there like the McGlones out there? Like, give us a sense of what's the farm economy in the U.S. now versus like family-owned farms versus, I guess, corporate farms?
Going much more corporate. So it was always a gentleman's farm. My grandfather bought it during the Great Depression, and he always cash rented it. That's a term you use. You own the land and just let other people farm, and they'll pay you a cash rent for that. Now, I know a few big producers out in Champaign, Illinois, which is some of the best ground in the planet, and they own the land, they manage it, and they just have farmers do it. So it's becoming much more corporate, but it's so efficient. It's just incredibly efficient. The key quote I get every time I get out there is the technology is so hard to keep up with. For instance, there's this thing called Exact Shot from John Deere, where they can now, when they plant that seed, give it the exact amount of fertilizer where it needs, where they want it, and it can reduce fertilizer costs by 60%. So it's just that rapidly advancing technology in that area. It's hard to keep up. Weather is still unpredictable, but we now have, with hybrid seeds and things like that, you can do pretty well with, for instance, here's a good example. When I was a kid, the average corn stalk had 1 ear. Now you have 2 or so per corn stalk. My question is, what stops that from going to 6 ears per corn stalk? It's just the trend's your friend for production, but not for prices.
Wow. All right. Let's switch gears here. I could talk, and we'll get to pork bellies at some point, but let's turn to gold here. Are we still just long gold and kind of short everything else?
I look at gold as the most likely asset and commodity to continue advancing. Now, that's not so profound because it typically outperforms most commodities over time, most notably copper, most notably crude oil. But the average price this year is $1,933. I love saying that, Paul, because that was a significant year where Franklin Delano Roosevelt debased the dollar versus gold, and that bottomed all the deflationary forces. It bottomed the stock market, and it bottomed deflation. But I look at gold, that's the highest average price ever, 1933. I see it as a bull market that's just waiting to break out. The key triggers would be some form of Fed pivot. As you mentioned in the earlier segment, the WIRP function is tilting that way. And I think the key thing to get that Fed pivot is probably a stock market decline. But to me, gold is, and I just showed on the year, it's up 6%. On a 12-month basis, it's up 10%. Virtually every other commodity is down. Here's the question. What stops that trajectory? I suspect it's more likely to accelerate. And as you heard Anna Wong in the previous segment point about recession, here's one thing I point out about gold is there's a 100% probability when unemployment rallies from this level, when it goes higher, that we'll have a recession, because that's the way it's always worked. And that, to me, is what's going to trigger gold. So my theme this month, as I'm probably my commodity outlook, is gold has been outperforming all other commodities. What stops it versus I'm fearful it's going to accelerate.
All right, Mike, always great segment. Always appreciate getting your color there. Mike McGlone, senior macro strategist for Bloomberg Intelligence, ensconced down in Miami Beach.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Simone, Foxman, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. Let's talk ETFs. And usually I want to talk about flows, where the money's going, and all that kind of stuff. But I want to do it in the context, I'll start off at least, by talking about Bitcoin ETFs, because our next guest has some experience in that. Greg Taylor, CIO of Purpose Investments up there in Canada. So, Greg, I guess in the ETF biz, at least here in the U.S., a lot of talk this week has been, hey, maybe we're going to get a Bitcoin spot ETF. You guys already have that in Canada, don't you? Can you tell us a little bit about the Bitcoin ETF?
Yeah, for sure. And thanks for having us on. In Canada, we like to think that we're one of the first innovators in the ETF space. A lot of the first in the ETFs globally have happened in Canada.
Nice.
And one of those of late has been the first spot, the Bitcoin ETF, which we launched at Purpose in February of 2021. And I think it's great to hear that the US is finally catching up and going to launch one as well, because really when you look at any type of ETF in a commodity world, you do want to have spot versus futures. And I think spot ETF is something that would be welcome to the crypto space. And the experience we've had with it has been very positive. And since we launched our fund in February 21, it's gotten over $1 billion of assets. It's one of the most heavily traded in the TSX. And I think it's been a really good experience for a lot of investors and a good way to get access to the crypto market in a more regulated environment.
So based upon your experience with a spot Bitcoin ETF, what do you think has been, or the SEC or the U.S. regulators have kind of misjudged about a futures versus a spot ETF?
When I think when you go between futures and a spot, I think there's no real argument that a spot one is way better. And when we set up to launch our ETF, we weren't really inventing the wheel. What we did is we really kind of copied or mimicked the way other commodity ETFs have done. Basically, the GLD is a widely traveled ETF in the US on spot gold. And I think it's looking at, when you look at a spot versus a futures, there's always better, because the futures is always going to lose basis points on the roll. So it was curious why the SEC would approve a futures-based ETF versus a spot, because at the end of the day, the futures are going to have to be backed by something. So there is a way to get back in the system, but having a futures-based ETF isn't really good for anyone or the system.
Now, we saw the price of Bitcoin pop after the decision came down in this case. I think there was a lot of enthusiasm. Hey, all these people are going to pile into an ETF rather than try and go out and buy Bitcoin themselves. That said, there's a JP Morgan strategist talking about how, if you have a launch, say, of one of these Bitcoin ETFs, it's not really going to change the overall market enthusiasm for this. It's just going to draw liquidity away from other products. Is this a zero-sum game to you?
I don't think it is yet, because I still think crypto is a commodity that's still really in the early innings of its growth, and I think having a spot ETF, which is one of the best ways to get access to it, is only going to bring on more investors. Currently, if you want to get exposure to crypto the traditional way, it's really not the easiest system. You have to open a separate account with a crypto provider. You have to figure out if you're doing a cold or hot wallet. And a lot of people just don't want to do that. So they want to wait for an ETF that's going to be easy and can track the index. And further to that, I think a lot of people are looking again at real assets. With the amount of money printing going on in central banks, there has been a case to add more of your portfolio towards real assets, and certainly the commodities and gold and real estate are benefiting from this. But I think there's also a way to get that crypto into that bucket of real assets. So I think there's demand for real assets, there's demand for crypto, and people want an easy way to do that. And I think having a spot ETF is one of the simplest ways to get access to it. So I don't think it's a zero-sum game. I think once the US does get a spot ETF, I think that will open up more buyers and sellers, and that's probably why the commodity reacted so well to hints that it does seem like the U.S. getting closer to approving this.
Hey, Greg, let's step back and take a look at the ETF space in general. Give us just an overview. Is the money continuing to gush into ETFs? Just give us a sense of how this year's been.
Yeah, we've had net flows, net positive flows this year. ETFs have definitely been a way that a lot of people are getting access to it. One of the big spots for this, for us, and I think for the whole ecosystem in ETFs in the last few months has been really looking at the money market ETFs. Certainly, money market has become a hot topic of late, and with yields for cash in the 5 to 6%, I think that's been an area that people are trying to get access to, and I think that's where a lot of the gains for the whole sector have been. But I think over time, people are looking for access and simple ways to get it. And in a low fee environment, I think ETFs are one of those ways to get access to it.
Greg, we've been hearing from some investment strategists pointing to sort of defensive sectors and away from like the tech-driven hype that we've seen over the past couple of months. Are we seeing places like healthcare and places like energy reflected in some of the ETF flows, and will we see more of that as we head towards the end of the year?
Well, I think that's certainly the hope. And being a Canadian, we're definitely, with our indices, tilted more towards the cyclicals and the resource sector. I think we'd love to see that rotation away from technology towards the commodity sectors, and we are starting to see that. Certainly, the last few years has been really good for the commodity growth as we've seen both energy and base metals do quite well, and I think that's really setting up quite nicely for the second half of the year. There's a lot of rumblings about China launching another stimulus program into September, and as the world starts to talk more about a soft landing, more stimulus from China, that's setting up for a decent move in the commodities, and I think that could cause more rotation away from these tech stocks, which have really driven the indices higher to start the year, and maybe some of that money flows back to the cyclicals, which are setting up quite nicely from a supply-demand economics. There's not a lot of supply for new mines and new oil wells coming on, so it does feel like the second half of the year could belong to more of the cyclicals than the tech stocks.
Hey, Greg, thanks so much for joining us. Really appreciate getting your thoughts. Greg Taylor, CIO at Purpose Investments, checking in with us, giving us the latest on the ETF space. Just continues to see amazing funds flow into the ETF space. Makes you wonder about the future of the mutual fund business, which we all grew up with. Now it's really, I think, in large part due to the cost differential. ETFs are a way to go for a lot of folks.
Yeah, places like Betterment, et cetera, have made this easy.
Yeah, exactly. And it's interesting. I think what I understand is from, tax-free accounts, still a place for mutual funds, but otherwise ETFs and the cost structure and the reporting and all that type of stuff seems to be a better wrapper.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we get some smart research coming out of the folks at Bloomberg Intelligence. Joel Levington, one of the smarter folks we like at BI. He's a director of credit research, so he better be good. But he's got a nice note out here on Tesla. And it's a little bit different twist here. And Joel covers the credit side of some of these industrial companies. He joins us live here in our Bloomberg Interactive Broker Studio. Joel, what do you think about Tesla here? Because our friends, in Detroit, Ford, GM, Stellantis, I think they've got some labor problem, don't they?
They have a massive labor problem coming up. There's a strike with the UAW that's going to be set for September 14th as they work through their contracts. Expectations are that pricing could go up 30 to 40% on their labor costs, which creates an opportunity for a low-cost player like Tesla to come in and continue to price down. Paul, the average Tesla price is down about 37% this year already. And if you look at, even if you look at consensus estimates just on their cars at the beginning of the year, it would have the market was expecting about $54,000 a car. It's down to $46,000. So they're really applying the pressure on these other old line ICE engine manufacturers to really step up or step out. And you're starting to see some of the stepping out already occurring. That might be exacerbated by a potential strike.
What's interesting with the strikes, though, is if the auto workers are pretty successful, then doesn't it create pressure on Tesla's own workforce to say, hey, they got a good deal. Maybe we'll get a good deal if we, resist the anti-union efforts of Tesla and go ahead and organize.
Yeah, 100%. And I would start with a base of if labor costs go up 30 to 40% at Ford, At a non-unionized plant like at Tesla, if it goes up 15%, you're still ahead of the game.
Good point.
At least on a relative basis, and you're already very far ahead of the game. And you have double the margins that you do out of Ford or General Motors relative to Tesla. So it just kind of further expands that difference.
Has there been any move to unionize Tesla over the years?
No.
Is there any expectation that will happen? UAW is saying we're just not going to deal with it?
I don't know if they're saying that we're not going to deal with it, but maybe this isn't the right moment for that to occur.
My impression is that Elon Musk's been quite resistant to it.
Yeah, but so what? I mean,
Well,
if I'm UAW.
You look at kind of the labor agitation that's been happening across the country between UPS coming in with a fantastic deal, pilots getting good deals, all that sort of stuff. You know, you do wonder if there will be an uptick. But Tesla's had as well some issues with its cyber truck. I wonder.
There is no truck. I mean, how can you be an EV? How can you be an auto manufacturer in the U.S. without a truck?
Well, I mean, they've been
trying. Truck gal.
I would love a truck. It's
Queens?
fun. It would be great, but you can now. I don't have a parking spot, so
okay.
Trying to find street parking truck. However, it would be cool looking. But we have a story out from yesterday. Tesla's Cybertruck is long on hype and short on specifications. But how meaningful is this to the company overall?
It's not. I mean, the Cybertruck is very, very niche. I know sometimes it gets compared to the F-150.
I drove the F-150 Lightning. Awesome.
It's a machine.
Yeah.
It is a very big machine, and Ford is dominant in that area and will stay dominant. The Cybertruck is a niche product, and if you look at consensus, that's exactly how they view it. It's not meant for the contractor. It's meant for probably a high net worth male that wants to be able to make a statement, I guess.
How are the bonds of the big automakers? How are they trading these days? How concerned are they about? I guess first, just this transition from internal combustion engines into electric. Like if I were a stockholder, I wouldn't want to get anywhere near these names. How about the bonds?
Yeah, you're totally right, Paul, as always. The stocks have really sold off over the last month or so if you look at Ford and General Motors. But the bonds have really held in relatively well. Maybe the CDS is at about 20 basis points.
CDS is credit default swaps.
Yes.
I learned that in the great financial crisis. I didn't know that before.
You're on point again. So they've held in pretty well relative to where the stocks are at. And I think that's largely because if you look at what the raters have said, they've said, if you go back to 2019 when the last agreement came out and there was a 6-week strike over at General Motors, they've already said, like, hey, a situation like that would not lead us to change our ratings. And so that's a pretty fair and long kind of expectation to have. In that case, back in 2019, it cost GM a little over $4 billion, just to kind of put that in perspective.
Well, Elon Musk finds himself constantly sort of embroiled in these scandals, whether it's something he tweets or most recently a reported probe into a secret glass house that he may or may not have been building. How do you think of headlines like this when you're evaluating credit risk? Is this something the market can just kind of like look past and wait to see where things go?
Yeah, well, with Tesla, there's always event risk just in headlines that you get. At least what I've seen on the credit side is that when he is quiet and the company is just working, their stock or their CDS and their bonds tend to perform better. So a lot of cases, it would just be better if things were quiet and you can kind of just move on and focus on your operating acumen, which they have a lot of.
What's the magnitude of some of these like reactions to I don't know if the glass house was truly like that big of a probe, but
yeah, for credit, I don't think that really means very much, but certainly it's just an unnecessary waste, use of time that could be spent better in terms of improving your products.
When's Tesla going to hit the bond market?
That's a great question, Paul. And I think really the answer is once they're done cutting prices. And the reason for that is one of the reasons that they can do as much as they've done this year. If you're talking about a 34% or 35% cut in your prices, you've never heard of that in autos before, right? You have to kind of go back to, Henry Ford days to get that kind of level of price cutting. And the reason for that is because most of the auto companies have captive finance units, right? So when you're taking a loan out or a lease on one of these cars, those cars wind up coming back, or a high percentage of them come back to the auto company. So they've financed that residual value at a certain level. So you can't go out and cut down the pricing by 30 or 35%. Otherwise, you're going to get destroyed in your finance company. Tesla doesn't really have that issue. And so they're able to be much more aggressive with their pricing and not impact their overall performance, whereas the old line companies can't do that. Once they're done with that, I think it's really, if you think about their strategy of growing production 50% a year for several years, they're going to have loans and leases become a bigger part of their business. And so that'll be the impetus for seeing much more debt coming out of the Tesla company.
I'm sure the bankers are pitching it. Joel Levington, he's the director of credit research at Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio. We appreciate getting your time there, Joel.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Let's talk the streaming biz. Netflix, clear winner. Everybody else, I have no idea. So, and I used to do this stuff for a living. Mark Douglas knows. He's the president and CEO of Mountain. He joins us live here in our Bloomberg Interactive Broker Studio. So, Mark, I mean, again, I think one of the questions people had at the beginning of this evolution to streaming was, okay, I get Netflix is going to win.
Yeah.
How about everybody else? We're now 2, 3, 4 years into this thing. We've got every media company is into the streaming business. What are we learning here?
Well, I think what we've seen, the reason Netflix continues to win is because they have all the content to watch when there's no other major show on to watch. And then they also have some of the major shows. So I think just about everyone, when you turn on the TV, the first thing you do is go see what's on Netflix, right? And then, so that puts them in the first spot no matter what. And then after that, the second spot is live television, which is like Hulu, YouTube TV. And then what Disney was pretty lined up to do was to really take that third slot, family programming, sports programming, but they seem to keep Star Wars programming, but they keep seeming to stumble. And so that's been the big challenge for that. And it leaves that third slot open. Max is trying to be there. Discovery's trying to be there. But I think most consumers are like, okay, I'm going to do Disney for 3 months, binge on that. Then I switch over to Showtime and watch the current season of Billions, but I'm going to binge that. Right. And I'm going to cancel that. And that's not really healthy if you're Showtime or Max or anyone like that.
So how are those folks trying to change their behavior and make their service a mainstay?
I think what you see is them trying to go back to sports programming, but then that costs billions of dollars in fees. So that's kind of like Amazon's strategy. And outside of that, I think they're like on a treadmill, and they really, quite frankly, don't know how to get off of that treadmill unless they're going to try to match the library of content that Netflix has. But Netflix is already occupying that spot. So what you're probably going to see is just a lot of consolidation. That's really where that number 3 player is going to come from.
Well, I mean, who can consolidate? Disney can't buy Warner Brothers Discovery or Fox, they consolidated. It seems like they already did consolidate as much as they possibly could in terms of the big traditional media companies. I'm not sure any more deals can get done.
Yeah, I mean, people say, of course, Apple can. I mean, they have like more money on hand than the U.S. government.
Well, Dan Ives from Wedbush Securities made a call a few weeks ago that he believes that Apple will buy ESPN, which kind of made some sense to me because, boy, that would be I think Disney, surprisingly, wouldn't mind getting rid of some or all of that, given the decline in, with the cord cutting issues. Is that something you think is reasonable?
Well, so the thing I think that's misunderstood about Apple is that Apple really wants to get a bundle. So if you watch something, you listen to something, Apple Music, you play it, Apple Games, you read it, Apple News, they want $20 a month from every iPhone user on the planet. And they only do TV to finish out that bundle. The other things like Apple Music, they have no production costs whatsoever. They don't make the music, they don't make the games, they don't make the news articles. And so the economics on that is they just give you enough TV content so you'll pay the $19.99 a month or whatever the current price point is. So I don't know that they have the incentive to expand their footprint on TV, given that the real money comes from the areas where they have no production costs whatsoever.
And I pitched them on every media company on the planet for 20 years and got nowhere with them. So.
Yeah, and notably, I mean, you point out this Dan Ives commentary, but our Dave Lee, an opinion columnist for Bloomberg, says Apple doesn't need to buy ESPN to win in sports. His argument is that they'd be better striking a partnership that would showcase the ESPN channel within the Apple TV Plus.
Yeah, I think that makes sense.
Yeah.
Also, Disney's this is the thing about Disney right now. Everyone if you have a great restaurant, and people don't seem to be showing up as much, you don't call your accountant. You call the chef,
right,
and say, what are we doing wrong in the kitchen? And so you see Disney. And people like, well, the company's not doing well, and everyone wants to call the finance department, and it makes absolutely no sense. Get the dishes right. They're like, get the food right. Get consumers.
What do you think Disney needs to do then?
I think when you look at the numbers, Disney, their revenue has grown they doubled in size over the last 2 years. Their revenue has grown, but if you look at their profitability, that is tanked. I mean, they were doing operating income like in 2019, I think it was like 11 to 14 billion, and now that's like 3 billion. So I think it's a classic story of everyone needs to get 10% better at what they do, and while doing it for 10% less.
Is AI the future there? Like AI generated content?
I mean, I personally think that it literally goes back to Disney, that the Disney brand, that people, especially in the United States where it got controversial the last couple of years, that people have to re-love the Disney brand. They have to re-love the Star Wars brand, the ESPN brand for sports. And that is not about deals on Wall Street. That is about who are leading these organizations under Bob Iger, and where is Bob Iger leading them. It's a very solvable problem. It's not going to be solved. I mean, doing deals to get more consumers watching your content, great. Do that deal with Apple. But like financial, I say at my company, the only type of engineering we're going to do at Mountain is software engineering. We're not doing financial engineering here. We're going to grow through products people love. And I think that is ultimately back to basics, what is needed at Disney.
Speaking of controversial products, CNN naming former New York Times head Mark Thompson as its next CEO. What's your take as we bring in a newcomer to try and turn the ship around? Yeah,
well, the folks at CNN there was a rebellion, right? And they literally, I mean, they tied the former guy, and they wrapped him in ropes and pushed him off the ship. so metaphorically. And so I think the new person that we're talking about, he definitely is someone that understands this staff, and I think is going to fit more there. The bigger news, I think, is making it more part of Max, because I think people just consume their news while they're consuming other things. Like, people don't wake up as much and go, I want to watch the news. They more say, I want to be entertained, and wow, the news is very entertaining today. In terms of new, kind of the CNN and MSNBC style news, we're sitting down in front of a television. So making that part of Max, I think, is a big deal. It gives them an audience to promote to. It gets more people just knowing this is an option when you go looking for content to watch. And I think that's the biggest move there.
Hey, Mark, you're based down in Miami. Your company's based in Miami. How big is this Lionel Messi thing?
Yeah, so Miami loves sports. I mean, like it has become. I used to go to Miami a few years ago and be, what the hell do people do for a living here? And now it's become so diverse, but in every way possible. and they love Formula One. They're loving, soccer or football, as the rest of the world calls it. And you see Messi posters all over the place. So I think it is a big deal. I think it was a perfect city for him. I'm not out that much, but apparently you can see him out a lot. And I think he's doing a lot for Major League Soccer. So I think it's a huge deal. And he was the perfect person. I mean, the World Cup, I think you can almost thank Salt Bay. Because Salt Bay made the end of the World Cup about Messi, right? Not just his play on the field, but
that was so weird.
That was it was like, why are you messing around with Messi? It kind of like he became a martyr at the end of the, in a couple seconds at the end of the World Cup. I think it's been great for him and great for the sport. Obviously, he was a phenomenal player before that,
and great for Miami, and maybe good for Apple, who was kind of part of this whole deal there. So Apple putting some dipping their toe again into the sports business. So we'll see. All right, Mark, thanks so much for stopping by. Mark Douglas, he's the president. He's the CEO of Mountain. Really knows what's happening in the confluence of media and technology, the whole streaming business, all that good stuff.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's check in with Anna Wong. She's a chief U.S. economist with Bloomberg Economics. She joins us here. Anna, we had a lot of economic data this morning. What did you take on the inflation picture here in the United States?
Right. And the inflation is still, I think the story of disinflation is still the dominant story. We saw the super core, which is core services excluding housing, surged in July, but that's driven by a very volatile category named financial management, and that's related to the stock rally in July. So I think, but all in all, for the real economy, what matters are the other super core categories, and those are still showing some signs of disinflation. On the other hand, consumption has seen a burst in July, and we traced that burst to the Barbenheimer and Taylor Swift and Beyonce effect. Yes, it.
Wait.
Wow.
Let's come back to that.
By that.
What are we ascribing to Barbie and Oppenheimer?
This burst in consumption
in
July. Yeah, and the biggest selling concert last year in North America is by a band called Bad Bunny. I don't know you, but I don't know Bad Bunny, but I do know Taylor Swift and Beyonce, and so together they make for kind of like a Olympic event in July, and that's why we see this unsustainable burst of consumption.
Yeah, that's real personal spending up 0.6% in July. That's the strongest advance since the start of the year. So you're saying, Anna, you said you don't think we'll see another number on this caliber because no Barbenheimer. Well, Taylor Swift's continuing, but I guess people bought tickets already. So we should look for that number to come down from now on?
Well, so Taylor Swift's tour in North America ends after August, and so is Beyonce's tour. So in the fourth quarter, there will be, just think about the fact that you don't even have a super pop star to maintain the same level of spending. That will be an automatic negative monthly growth going into September. And then on top of that, you have the underlying force of consumer balance sheets worsening as they have to pay back student loans, and we're seeing an uptick in delinquencies in credit cards and auto loans. So yeah, I don't think it is sustainable. We likely will be seeing some negative prints in consumption going into the fall.
I wonder if this is a new lever of Fed policy. Have Jay Powell call up Taylor Swift, call up Beyonce, tell them when to schedule their tours to adjust to as a new lever of monetary policy.
So, I mean, and I'm guessing at the University of Chicago, where you got your PhD in economics, they didn't give you, there wasn't a class on like T Swift or the concert impact on GDP and inflation.
Studying the Beatles and all that.
Yep.
They do teach us that people are rational, but the fact that consumers are spending money that they don't have seems to me that, in fact, they give too much credit to the median American consumer.
Right. All right. So can we take, Anna, can we take recession talk off the table once and for all here?
Definitely not.
Oh, that's just your
anything,
model speaking, Anna.
No, if anything, this temporary boom in consumption is actually increasing the possibility that in the next couple of months we are going to see a negative PCE in consumption, and that's one of the indicators that go into the NBER recession dating. And also on top of that, going into the fall, we're going to have likely going to have a government shutdown as well as a UAW auto strike, and that could, both of them together could potentially turn the non-farm payroll report for October negative. So there you have it. You know, the two remaining NBER indicators that was in positive territory that kept a recession away, those are turning around likely in the fall.
I want to address another somewhat cynical story that we had out yesterday. Poor Americans tap debt, buy less food as consumer cracks widen. Essentially, this was a survey of people on SNAP assistance programs. So people who with incomes at or below the poverty line, saying 42% skipped meals in August and 55% ate less because they couldn't afford food. That's more than double than last year's shares. Talk to me about how the federal government addresses what seems to be a clear divide between higher income consumers and lower income consumers if they're trying to cool off inflation, but without hurting the bottom half.
Yeah, you're absolutely right, and it's an impossible balance to strike because monetary policy is a very blunt instrument. It does not differentiate between lower income and higher income, and this is why high inflation, running the economy hot in order to boost unemployment and on the lower. That was the motivation for running the economy hot, right? But ultimately, inflation hurts the bottom percentile of the household more than the upper half. So it's just an impossible balance to strike.
All right, so Anna, I'm looking at the WIRP function on the Bloomberg terminal, the interest rate forecast. Lots of rate cuts kind of is what the market's suggesting for 2024, yet it's been hugely wrong for a long time, kind of what the market's looking for. What do you think the Fed's going to do in 2024?
Yeah, I actually thought that what the market priced in so far, about 100 bips of rate cuts, is reasonable by our model because so I think that's a reasonable thing to price in.
Yeah, I wonder, the Fed says, well, Jay Powell says, don't think about cuts. And yet it seems like the market's certainly pricing in, looks like four cuts by the December meeting next year. Really quickly, we only have about 30 seconds here. What are you looking for from the all-important jobs report tomorrow?
We're expecting 185K change in non-farm payroll and an unemployment rate of 3.5%.
You're not going to get a recession with 3.5% unemployment, Anna. So I'm just telling you right now, I know you've got a PhD in economics from the University of Chicago, an undergraduate degree in economics and statistics from this little place called Berkeley. I took 2 economics classes at business school, so I think I know what I'm talking about here, despite your PhD. But we'll see how it plays out. I'm in the no recession camp, but Anna Wong is so much better than this, than the rest of us and all this stuff. We appreciate getting some time there.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I buy my securities. I hold them. I'm not trading. But a lot of folks do buy and sell, buy and sell, buy and sell. And oftentimes the timing there isn't ideal. And that, in fact, really impacts their returns. Kind of what have you experienced in your career?
So a lot of this just traces back to the emotionality of having capital at risk. The upside is hey, everybody, we're all going to be wealthy. Isn't this fantastic? And everybody is always happy when the markets are trending up like they've been for the past week. In fact, back to, October 2022. But when you go through a full year like 2022, people get very uncomfortable. Your emotion gets in your way. And lots of studies have been done on this. There's the Dalbar study. There's countless academic studies. The one that intrigued me most recently came from Morningstar, sort of kind of snuck out in the middle of the summer, called Mind the Gap, and it's really fascinating.
And what does it kind of show us?
So when you look at the traditional studies of underperformance of investors, they tend to say, hey, your stock selection or your market timing or your use of leverage has led you to underperform the benchmark. And everybody kind of understands that. What's really shocking, and this is what the Morningstar study called Mind the Gap showed, is not only do investors underperform a benchmark, they actually underperform their own holdings, meaning if you own ETF 1 and mutual fund 2, you would expect that you should get as much returns as those products create. But the average investor underperforms those holdings by about 22%. And the reason is what you alluded to before, timing. They tend to chase products up or panic sell on the way down, and that always leads to not just bad performance against the benchmark, but you literally are doing worse than the products that you own. It's quite fascinating.
Interesting. Well, interpret for us the confounding mix of data that we're seeing right now. I believe UBS Jason Draho termed it a Marketheimer effect, incongruous data, and differing opinions of where the Fed is going to go. How do you play this at this moment? What are the salient points that you've been following?
So first, all economists suffer physics envy. You can land, physicists can land a craft on an asteroid going 50,000 miles away, 50,000 miles an hour, 10 million miles away. So economists are jealous of that, mostly because they can't even tell you in real time if we're in a recession or not, right? So when you compare the two sciences, and I use that term loosely, one is a very precise science that does unbelievable things, and the other are a bunch of sociologists pretending to have a math background and pretending that they're physicists. So start with that bit of bias on my part. And then second, remember what the statistician George Bach said. All models are wrong, but some are useful. And all of us, investors, strategists, but especially economists, tend to forget that. When we have a model of inflation, when we have a model of GDP, we think somehow that these models are the Delphi of Oracle, and they're telling us the truth. What they are is taking a super complicated world with a million moving parts and thousands and thousands of data points and saying 2.2%. The old joke is, and I don't want to just beat up on economists because investors and strategists, all of us engage in this foolishness, but the old joke is, why do economists show data to the second decimal point? And the answer is to demonstrate they have a sense of humor.
I love that.
Interesting. Hey, Barry, one of the drivers of the stock market performance this year has been AI. And a lot of skeptics are out there saying, boy, I'm not sure if this is real or if this should be really driving the markets here. The AI may be overplayed. Do you have an opinion on that?
Yeah, and I think it's when you go back and look at history, no matter what the new technology is, the cycle is kind of similar. Some people have called this the Gartner hype cycle, but think back to internet stocks or biotech stocks, or if you really want to dust off the history books, railroad and steel stocks. A new technology comes along, it changes everything. And while that's true, nobody knows who the winners of that are going to be. And so you have this land rush. Think about who's left standing in the world of personal computers. I mean, at this point, it's Apple and Dell and not a whole lot of other people. But at the time, there was a giant land rush. There were hundreds of companies. Most of them fall by the wayside. Radio, television, automobiles, pick it, fiber optic, pick a technology, and it's the same thing. So AI is probably going to be a big thing at some point in the future. Figuring out which company is going to be the winner, I don't know if it's Microsoft or NVIDIA. History has shown us that very often there's a surprise winner in it. The fact that we're talking about NVIDIA for a long time, hey, they were an also-ran in the chip world. Maybe they have this floating GPU thing that we could use for gaming. Think about how rapidly things change. But by the way, not too long ago, I love finding these old magazine articles. There was one about the BlackBerry versus iPhone, and this was about 20 plus years ago, and I'm sorry, about 15 years ago in the late 2000s, like 09, 2010. And here's why the BlackBerry, has a lot of fight in it. And this interloper from Apple, they're a computer company. What do they know about phones? So our ability to forecast the future, especially with technology, it's pretty mediocre. We don't do a great job. AI is great. Your guess is as good as mine as to which company ends up being the winner.
Hey, Barry, thanks so much for joining us. As always appreciate getting your unique perspective. Barry Ritholtz, he's the host of Masters in Business on Bloomberg Radio. Great podcast. I recommend checking that out. He's also the chairman and chief investment officer of Ritholtz Wealth Management. And when Matt Miller's in the studio, they tend to go off the rails and talk about cars.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.